Today in financial accounting, let's look at revenue and expense recognition. Today we'll mostly focus on accrual basis accounting, but let's start with a simpler question. What's a revenue? These are amounts recorded when a company sells products or provides services to customers. It could include groceries from the grocery store, a new custom dress, soccer camps, or a car wash. Now let's talk about the revenue recognition principle. A company records revenues in the period in which it provides the service or product to the customer, regardless of when the cash is received. For example, in March, a customer shops at your grocery store. After paying for their items, the customer takes her bagged goods home. We record revenue in March, the same month as we provided the product and the customer paid. Now let's look at another different example. On May 1st, a customer comes into your custom dress and suit shop and orders a custom dress for an event in June. She pays cash at the time she orders the dress. On June 15th, she picks up her custom dress for her event. When would your shop recognize and record the revenue? Your shop would record the revenue in June. This is because that's when you provided the product to your customer. When a customer prepays for a product or service before it is provided, this is considered a deferred revenue. The amount is held in the deferred revenue liability account until we provide what was promised. Let's look at another example. On July 15th, your business provides a soccer camp on account to a local team. The team promises to pay for the camp by the end of August. On August 15th, you receive the payment from the team. When should you recognize the revenue? Your business would recognize the revenue in July. This is because that's when you provided the service to the customer. This is an example of an accrued revenue. This happens when we record revenue in the current period that will be collected in a future period. Now let's move on to expenses. What's an expense? It's the cost of providing products and services. It could be like advertising, employee pay, rental expenses, and office supplies. What's the matching principle? That's where we report expenses in the same period as the revenues they help to generate. For example, some costs may match directly with the revenue they help produce, like advertising for the current month. If we pay for advertising in September for the month of September, we would record the expense in that month. Let's look at another example. What if we had prepaid for 12 months of rent at the beginning of December? At the end of December, we will have used a month of rent. We will record the rent expense for the amount used at the end of the month. This is based on the assumption that the cost of rent for the month helped produce the revenue for the month. Let's look at another example. Employees may earn pay in one period that will be paid in another. Salaries need to be recorded in the period the employees worked, even if they are not going to be paid until the next period. Your employees worked 4 days at the end of December, but won't be paid for those days until January. You will record the expense for the 4-day salary in December, even if they aren't being paid in that month. This is an example of an accrued expense. It's based on the assumption that the employee's work helped produce the revenue for the month they worked. So in accrual basis accounting, we record revenue when we provide services or goods to the customer, not necessarily when the cash is received for it. We record expenses in the period in which they help to generate revenues, not necessarily when they are paid. There's another basis of accounting that exists, and that's called cash basis accounting. In cash basis accounting, we record revenues when we receive cash, and we record expenses when we pay cash. The difference between the two is going to be timing and one other thing. Accrual basis accounting is compliant with GAAP. Cash basis accounting is not.